Dear Krista Jayanti MBA students, welcome to Financial Markets and Services class. In this class we are going to discuss about the basic primary financial instruments available in India. The specific financial instruments will be covered in the next lecture hour. The conceptual background of the financial markets is explained in this show. The types of financial instruments are discussed in this class. Let us start. What is a financial instrument? A financial instrument is a monetary contract between two parties which can be created, traded, modified, and settled. It can be evidence of ownership of an asset. It is also called as financial assets and financial products. It gives rise to both financial asset and financial liability. Financial instruments provide an efficient flow of money and transfer of capital throughout the world. These tools can be real or virtual documents representing agreement involving any monetary value. It has a monetary value, and it constitutes a legally enforceable agreement between two or more parties regarding a right to payment of money. The basic classification are as follows. Money market instruments. Money market instruments include call or notice money, caps, and collars, letters of credit, forwards and futures, financial options, financial guarantees, swaps, treasury bills, certificates of deposits, term money, and commercial papers. Capital market instruments. It includes instruments like equity instruments, receivables and payables, cash deposits, debentures, bonds, loans, borrowings, preference shares, bank balances, etc. Hybrid instruments. It includes instruments like warrants, dual currency bonds, exchangeable debt, equity-linked notes, and convertible debentures, etc. Let us discuss the types of financial instruments. What are cash instruments? The value of the cash instruments is directly influenced and determined by the markets. These are the kind of securities which are easily transferred. Loan is basically lending money from individuals, organizations, banks, trust, etc. Till the time the entire amount is given back, the recipient has to pay interest. Equities is a type of security that represents the ownership of a company. Equities are traded in stock markets. T is one of the best options to invest in equities over an extended period, as it will fetch good returns. It is also subject to market-related risk, and one needs to do thorough research before investing in equities. What are bonds? Bond is a type of long-term debt instrument in which the issuer owes the holder debt and is obligated to pay interest, coupon payments, for the specified amount of period, maturity date, and a later date. Bonds are fixed income instruments which are issued to raise working capital. Both private entities, such as companies, financial institutions, and the central and state government institutions, issue this to raise funds. The bonds issued by the government carries the lower rate of risk but guarantees returns. Derivative instruments. A derivative is a contract between two parties which derives its value/price from an underlying asset. The most common types of derivatives are futures, options, forwards and swaps. It is a financial instrument which derives its value from the underlying assets. The value and characteristics of derivative instruments are based on the underlying components such as assets, interest rates, or indices. These can be over-the-counter derivatives or exchange-traded derivatives. Bond futures contract is a predetermined contract where the buyer or the seller agrees to buy or sell something at a predetermined time and a predetermined price in the future. The asset is usually a commodity or a financial instrument. Options on bonds. Options give the buyer the right but not the obligation to buy or sell the underlying asset on the option at a specified date and a specified price depending on the type of option. In case of options on bonds, the underlying asset bonds, it is classified into call options and put options. Interest rate swap. It is a type of interest rate derivative which involves exchanging interest rates between two parties. Certificate of deposits. A certificate of deposit is a time deposit, a financial product commonly sold by banks, thrift institutions, and credit unions. It differs from savings accounts in that the CD has a specific, fixed term, often 1, 3, or 6 months, or 1 to 5 years, and usually, a fixed interest rate. Foreign exchange instruments. The main trading instruments of foreign exchange market are the currencies of various countries. Currency rates, that is to say their relation to the Indian rupee, are formed by the supply and demand of the market and also by various fundamental factors. These include currency swaps, foreign exchange options, foreign exchange swaps, and are mainly related to currencies. Mutual funds. A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. In India, mutual funds are top-rated because the initial investment amount is very less and the risk is diversified. Mutual funds allow a group of individuals to invest their money together. The investment avenue is famous because of cost efficiency, risk diversification, professional management, and sound regulation. The minimum amount to be invested can be as small as rupees 500, and the frequency of investment is usually monthly or quarterly. Variety of financial products like mutual funds, insurance, shares, debentures, derivative instruments, etc. are available in India. However, the reach of these products is very limited and the features of many of these products are very basic in nature. Further development and innovation in these products would be faster if they are accessed by all classes of investors in urban as well as rural areas. The thrust lies mainly on the development of new financial products to deepen the improvements in the product distribution itself. The responsibility of ensuring these improvements vests with all the stakeholders in the financial services industry. The specific financial instruments will be discussed on Saturday, May 22, 2020, Zoom class. This video is exclusively prepared for Krista Jayanti MBA students. This presentation is edited by Gnanakumar. Thank you.